It's great to see you all here. Sri, I'll just kick it off with you because I know you've been a little bit more biased towards a hike lately. Do you still feel that way after today's report, today's data?
Good to be with you, Kelly. And as you just explained, the inflation figures are still very elevated. And keep in mind that we have had high interest rates for almost a year. The Fed has not cut interest rates in about a year's time. And still, the economy continues to be very strong. The wages are strong. And despite the slight slowdown in the first quarter GDP number, this is still a relatively strong economy. So what that says to you is that interest rate increases have not done the job yet. Or if you want to go into the geek expression of the Federal Reserve, the R star, or the natural rate of interest, which neither stimulates nor cuts back on the economy, is still much higher than where we are today. Even the 5.5% federal funds rate doesn't cut it. And you need something even higher than that so that you can have a restraining influence on the economy. And that's what the inflation number, the GDP number, and the consumption spending number is telling you.
You're not worried we're on the precipice of a slowdown? I noticed that economists over at Citi, which have been more tempered in their gains expectations of the employment report, think we might only add in the range of 140,000 jobs. You know, we're starting to get down into, uncomfortably low territory. Could the slowdown be just around the corner and help solve some of the inflation problem?
The slowdown may be around the corner, but I'm not sure that is going to solve the inflation problem, Kelly, because you still have a lot of liquidity in the market. Fiscal spending has increased substantially, as even Treasury Secretary Janet Yellen has acknowledged this week. They are going to keep the pressure on prices. So you're not going to have prices come down significantly, even if you have a weakening of the economy. So the Fed is not going to get a break.
I know, Jay, that you're also a little bit worried about inflation. Where are you guys on what we might see in the employment report next Friday? I mean, are we going to have this? And I know that, Michael, this is Michael's kind of base case here. Are we going to have this stagflationary kind of scenario to start talking more about?
So, Kelly, our expectation for the employment report is we're looking for about 195,000 jobs. So that's a little bit of a bounce back from what we saw in April. But, keep in mind, these numbers can be pretty choppy on a month-by-month sort of basis. And so what you really want to look at is kind of, the 3-month moving average. And we think that's going to continue to come down. And, if you continue to see what we saw in the other part of this report today, that is real spending actually declined in the month of April. We're starting to see signs of stress in terms of the consumer. If we can continue to see that going forward, then those employment numbers are going to continue to come down. The economy probably will continue to soften up, and that should put some wage pressures, bringing them down to help bring the overall inflation rate down as well.
But until that happens, are you biased? I think, if I'm not mistaken, you've said we need more progress on inflation before rate cuts are in place. So even as you're describing a potential slowdown, I'm not hearing you say that's why the Fed needs to get ahead of this and start, loosening policy.
No, Kelly, I don't think we're quite there yet. And if you read the rhetoric coming out of the Fed, I mean, they want to see a number of months of this. I mean, the 0.2 today in terms of the core PCE, the month-on-month change, that certainly is welcome. But that's the first 0.2 we've had in a number of months now. We need to see more of that. And so are we looking for the Fed to cut rates, in the near term? No. I still think September is potentially on the table here. This today didn't rule that out. But again, I think you need to see a number of months of 0.2 and softness in terms of consumer spending for the Fed to actually then start to cut rates.
Michael, I always feel like the stagflation we might get might be a point in time, but not necessarily. So in other words, the economy starts slowing, but we know it's going to take a while to really feed through to inflation. Think about something like car insurance or home insurance. How much does the economy have to slow for how long? 18 months before that really starts to change the way that those rates might move around, So I don't think we can all expect the moment that we start seeing, slower payroll growth, that we're also going to start seeing slack on the inflationary side, unless that's your expectation.
Well, I think that's exactly what you're describing is exactly what we're seeing, Kelly. This has been the most telegraphed and long period of time leading to a recession. If we even get one, we're not even sure about that. But it is, that's why I say inching towards stagflation. We're sort of getting there slowly. We've had growth, but it's declining. Job growth was strong. It's getting weaker. The composition of jobs is more geared towards services and government versus industrial strength and animal spirits type job growth. You've got higher for longer interest rates. You've got sticky inflation. You've got consumer data getting a little bit more nervous in terms of credit card defaults, auto payment defaults, et cetera. And you have corporate earnings that basically were pretty good for Q1, but the outlooks were a lot more cloudy in terms of what companies are saying going forward. And look at something like Salesforce a couple of days ago. I mean, is that a harbinger of things to come? It's a distinct possibility. And so you do have to worry about that economic slowdown. And the inflation is sticky because we've had a lot of stimulus. It hasn't worked its way through the system yet. At the same time, you've got slowing growth, and voila, that's where you get stagflation.
You worried about market breadth? I'm seeing more and more notes about this. I think Bespoke had one yesterday. Our guest spoke about it, David Harden, yesterday as well, that we're not seeing as many stocks kind of broadly experiencing the same gains in performance that we've seen, for instance, the Mag 7 experience.
I think the market's trying, and one of the previous guests mentioned some broadening out on one of the data points. So yes, it's been broader than it has been at other points in the last year. But no, it is still very, very concentrated, and I think that is also a sort of equity risk, if you will.